Let's take this discussion forward. Joining us right now, Nitin Gupta from SBI Capital. Nitin, hi morning. We just gave a 360-degree perspective on what experts feel, what some of the earnings have been so far. Where really things stand when it comes to consumption, and case in point being Westlife yesterday. So if you go by the earnings that Westlife has delivered, it seems that niche consumption stories pretty well within the sort of mid-affordable segment continues to be completely untouched by the slowdown.
Good morning. Basically, first to clarify, I look after the FMCG space, and in FMCG broadly we are seeing 6-7 trends in the near term. So first is the rural slowdown. So rural has remained slow, and even the Nielsen data is highlighting rural growth from 5.3% in Q3 gone down to 5.2%. So that way rural is stable, and but here what we are observing is that there are total 4 stages of rural slowdown. So first stage is they seek more value from the existing money. Second stage, they want to cut down spending. Third, they are looking to cut down on discretionary consumption. And fourth, they will migrate to sort of downtrade to unorganized. So in the first phase, what we have observed, companies have gone through increased promotion that has played out well. In the current second stage, what we are observing is that most companies are cutting down on prices with tactical price offs. Case in sight would be Marico, HUL and other companies who have taken price offs tactically, and that is the sort of placed well in the market. The third stage is the discretionary consumption cut down, which we have observed in select categories or companies like GCPL's hair colors, Imami's most of the portfolio. So that is what we are observing now, and if the demand is stabilizing now at this level, then rural is placed well, and the consumption slowdown won't will continue in the near term. So this was mainly the rural slowdown. Second is the premiumization trend, what we have observed. So urban affluent class is consuming well, and that is continuing to do well. You can take a case in sight, Future Consumer had to close down Easy Day stores while Nature Basket from Godrej moved to Goenka Group. So that's self suggests that overall premium affluent class is doing well, and there the demand is remain robust. FMCG in this last 3-4 quarters, what they have also tried to do in terms of launching low unit pack of premium portfolio, which is also placed well, and that is what helping the overall margin trajectory. The third part would be the this is for this quarter only, where the winter is crucial. So we have attended CI conference where Nielsen has presented a presentation where they have noted that in October there is a recovery in growth for FMCG sector, but towards the end of the quarter they are highlighting there is a deceleration in growth further. So that suggests that November and October's are weak, and what based on our channel checks we got to know that this intensity of winter was towards the end of December. So as such, the primary sales though have come, but secondary sales have not happened in November and half of the December. So where the companies are likely to see some pressure, like companies like Imami and HUL are likely to be impacted because of this. While on the contrary, we have observed Dabur played out this trend well, and their Chyawanprash, honey have did well, and they have also leveraged the opportunity of this pollution in North India well. So that's how winter is overall a sort of decelerated demand in November and December. And fourth part would be the international bit in the FMCG, where across all FMCG companies we are expecting for at least for this quarter the international should do relatively better than the domestic, given the high single digit constant currency growth with some positive mix of the currency effect. So that's how we believe for this quarter. Across the demand is stable, and urban centric FMCG companies should do well, and given the international growth likely to improve, so some of the companies will see benefit of that.
Okay, Nitin, I think you've nicely kind of summed up some of the key points there. Just before we let you go, would you be able to quantify the kind of pickup in growth that you're expecting?
Pickup in growth, based on our channel checks and interaction with the multiple companies, what we have observed that there are no green shoots. But given this is this slowdown is sort of culturally driven, where we have implemented demonetization and your GST. So that cultural shift, the way of doing business is affecting the trade. So that will sort out and hopefully we can come to stability. What Nielsen is projecting 9-10% growth for next year, that is feasible. But in a country where we are expecting that we are aiming for 5 trillion economy, and if we are a believer that GDP growth will improve, so that basis we believe that rural should improve. So if rural will improve, we will have to see which all companies are placed better and how they can extract better growth. So that's how we believe that rural ideally should improve, but there are no green shoots as of now. Government steps, whatever these guys have taken, has not materialized as of now, because like some of the pass through happened through the tax rate cut, where government intention was to company should invest more, and that decision is sort of will come into effect with a lag, maybe in this year's annual general meet or in the meetings. Companies will take a call whether to go for a capex or not. Particular to FMCG companies, these companies have gone for capex in 2017, where they got fiscal benefit in Assam. So
Sure. All right, Nitin, we'll have to leave it there. Thanks so much for joining us this morning and running us through your views.